Welcome to the Twomey Stock Market Report. I'm James Twomey, and this is a subscriber's video. Today is Wednesday, 11/9/2022. It's about noontime, so we'll be able to do some real-time trade updates here. And I want to go over multiple things on this video. So let's get right to it. Right now, what we're looking at is a market that may be in flux. So insight on market fundamentals. What can we say about the market? Well, the market is giving us a few mixed signals right now. We're hearing a lot about the high-tech sector is running into a headwind. The Meta has announced layoffs of some 10, 12,000 people. We've seen some other, obviously, last week, we had the sell signal on XLK, which was our high-tech play into the NASDAQ. And it's definitely seeing companies in the high-tech sector still struggling with revenues and also meeting expectations. On the other hand, we have the Dow Industrials, and let's go right to that chart while we have you. Let's see if we can pull that up real quick, and we'll go to the Dow Industrials. We use the diamonds as that, and what that is telling us is, we've seen a complete reversal from the bottom back here in, mid-October, and here we are all the way up almost back to the highs of the summer bear market rally. Yeah, we're kind of having some struggles here the last few days, but overall, we've had a nice run from our buy signal. So what is happening? We've got industrials doing well. We've got the large caps doing well. And then we have, interestingly enough, small caps kind of not doing so bad either. But the NASDAQ and SPY continues to struggle, mostly because of the high-tech sector and some other areas that are pulling and weighing that down. So fundamentally, are companies doing well? The ones that are doing well, who have good cash flow, good market cap, reasonable price to earnings ratios, are all having some positive news in their either earnings or stability of pricing. What does that mean? They have the ability to pass on prices to their customers, and the customers are willing to pay that. Now, that also brings us to our secondary. Why is that happening? And there's two factors there. One is, it's the infrastructure bill has been out there for a while. It sounds or appears that the industrials are starting to feel that impact, and therefore spending is occurring. Caterpillar, for example, is way up, right? We've got these industrial companies doing extremely well. Let's go to Caterpillar, and had some great runs. This would have been that's the daily chart. And look at that. We're way up to, back to the summer highs. And that would have been a great buy. We had the buy signal on that. I did not issue it because I wasn't sure about how that was all going to go. And, it's one we should have been in. And anyways, the industrials, let's see, I think it's IYJ is industrials. You can see that's there's a buy signal back here, but that is running not as good as Caterpillar, but it's certainly showing us that they're doing well. Now that brings us to the other thing. Why? Well, okay, there's got to be an influx of cash to keep these companies. The companies are well run, they're large, they're pretty well stable, they can play with their bottom line either through acquisitions or, if they have a lot of cash and then take up their competition, smaller competition, or they can, balance their workers either through, smaller attrition or adding very quickly, and usually worldwide. So they are being affected by the dollar being more expensive here in the U.S. When I mean more, higher value, and are raising rates. But overall, they're weathering it pretty well, which is really interesting. The other part is, we touched upon it. The second part is employment. The employment numbers are still healthy and strong. Now that's going to cause a couple of other issues. With employment strong, and people have the ability, even though inflation is there, it's going to be a costly endeavor for us to, go to wherever to shop, buy, or what have you, especially, bigger ticket items. It really weighs on the consumer. It has not impacted, it is slowing down, yes. It hasn't impacted totally on some of these bigger firms. It also, we're starting to see it, in the high tech sector because people aren't advertising, they aren't spending as much. The gig economy is probably, all these folks that started their small businesses and advertised on Google clicks or, uh, Facebook and that, they're all pulling back because they weren't really making a ton of money. And big companies, if they are going to, pull back, they're going to pull back in some of the social media spending because it's, even though it's a good avenue, they just don't need to spend that much on it. It's they're gonna look ways to improve their bottom line, right? Because they have to pay their workers more, they have to pay insurance more, they have to pay all those great things because the cost is going up, and they have to pull in somewhere else. And that's what's happening. That really is what's going on fundamentally. These companies are starting to struggle, but the big industrials and the bigger companies are making it work. We had the election midterms last night. It hasn't been totally resolved yet. It'll be a couple of more days. I expect the market to be. I sent out to the subscribers changes to our stops. I expect there'll be some volatility. I don't know where the election is going to settle out. The market does react positively to gridlock. What do I mean by that? When there's Washington has, a mix of parties in charge, so that one party doesn't run totally with their agenda, and there's always a more checks and balances. And the stock market says, well, there's not going to be a lot of radical change. And, I use the word radical. It doesn't mean, major change. Let's use that because radical sounds too political, but major change. And what happens? Not much gets changed. And then companies go, hey, we've had this in our earlier videos. I haven't talked about it in a while, but that's the environmental factors. Taxation, tariffs, all those types of things that normally would change a company's borrowing or changing of their habits, that tends to not be so demonstrative in change because Washington can't get anything accomplished, right? They're one side cancels the other. So if we end up with kind of a mixed bag in Washington, it's a good thing for the market. I'm not sure. My guess is if let's say the current strength stays on the Democratic side, it may affect our energy plays, and I'm not sure. We have to really look at that. Our energy companies are doing really well. Our energy plays are doing really well, but they may come under pressure. I'm thinking if energy at all gets, let's say the Republicans come in more in charge, they're going to probably relax some of the restrictions or try to. I don't know if they'll get it through. They would try to release and typically since energy trades on the future prices and they feel like there'll be more energy available, those, maybe energy prices will come down. I don't know. I mean, that's one side of the coin. The other side is if the current strength stays in play, they're really pushing towards green energy, and green energy, unfortunately, we don't have a total solution. I'm not saying it's good or bad, but there's just no total solution out there. So without a total solution, we run into, some really difficult times in how to get that accomplished. So if we look at our sector table, I didn't mean to go on that, but if we look at our sector table, you can see the last 6 months, what do we've got? Industrials, energy up there. And, I usually track this by 1 month for our, subscribers in our market report. And, industrials 11.11%, 11%, and energy 10% the past month, and 9% financials and materials 9%. So, we've gone into material plays. We've gotten burnt quite a bit. When I say burnt, we just haven't made the money that is promised. There is a buy signal that we have in the gold miners that we like to play. I haven't issued it yet. I want to get, I think there's plenty of time to get in that if the market plays out. Brings us to our last point. Our last point is what happens if, if that market does change. I think with the election, that's one thing, but also we got the CPI data coming out this month, and preliminary, and I wrote in the market report, is that the preliminary flash is saying it's going to be higher. We don't know until it comes out. But if it comes out higher, the Fed's going to have to continue the gas pedal on raising rates. We're not done with raising rates. And if and when rates come out and the Fed comes out and says we're going to pause rates, or we're going to be more data dependent, it looks like we're not sure we're going to raise any. We're going to go into a more flat raising rates. In other words, rates stay the same. Let's say they get to 5.5%. That's where they're kind of targeting 5.5% at the end of December, beginning of the first quarter, January, February. And they start, I believe that's going to be really positive for the market. The market's going to react to two things. Typically, the midterms, 6 to 12 months, we get a nice rally in the market. All but one midterm that happened in the last, since the 60s or 50s. That's been in my market reports. We'll update again in the future reports. But also, too, when the Fed says we're going to curtail rate increases, the market tends to race off. The last market report, I gave you some data from Sublist out of JP Morgan, who did some pretty good history. I wish he would give us a graph of real time now. So I'm trying to pull that together myself. But basically what happens is the market employment will probably start to show cracks, and the market will start to move up if the Fed's holding rates. So what does that mean? The Feds raise rates to the point where it drives, if you will, a recession, even though, and what happens, companies pull back and there's more major layoffs. We go from an unemployment of 3% to one of 5%. And so employment figures come down, and then all of a sudden, since the market is flat on raising rates, the market starts to go up. So the market's a predictor. So we're going to wait for that to really say it's the all-in signal. Right now, we're just playing trades. It's a little frustrating because we're getting stopped out quite a bit, or we're selling quite a bit. And that, we've got some terrific gains, no problem. So that's the overall fundamentals, technicals. So we looked at diamonds. The diamond is starting to flat out here. We look at our Twomey trend track line, and that is certainly showing upward movement, and we're above the 200 EMA from a technical perspective. The black line here, let me make this bigger. The black line is the 9 EMA, and the 14 EMA is in the orange, if you will, and then the green is the, I believe I'm using that's a 20 EMA for that one. So what are we seeing? Well, we're seeing a very positive flow in these industrials. We've got a couple of areas that could be technical support. First the 9 EMA, then the 200, then the 14, then the 20, and then the 50. Very positive. Now let's compare that to the NASDAQ, which is the weakest of all the indices, right? And this is the kind of, again, wow, what a crazy chart this is. I'm going to get rid of some of this and we can come back to it. Let's face it, the NASDAQ is the weakest for sure. Now, are we a pure technical trader? No. Are we pure fundamental? No. We take the two. Fundamentally, we look at the market, we look at the trends, we look at the macroeconomics of what's happening out into the economic side of the equation. We look at the environmental, what's looking at more of the impacts on the environment, not climate. It's the environment of investing, the companies, are interest rates going up? So companies have to pay more. If they pay more, they're going to reduce their expansion. Are there tariffs? Are there, Washington came out and say, hey, we're not going to have a pipeline, so therefore it's more expensive to move oil around the country. You name it, the war in Ukraine. These are more, impacts that are going to change, even though economically things may look good. So and then we start looking at all our technical indicators from relative strength index, advanced decline, our EMAs, our convergence in the MACD, right? So we look at all these mathematical and we apply those and we use those as guardrails for our fundamental and trend decisions, right? So, all right. So back to the story on NASDAQ. Let's reverse this. Look at the 200 EMA is way up here. We're above that in the Dow. Over here in the pink is the 50. We're well below that as well. We're below the 9. We're below the 14. And it's going sideways, which is kind of good. When you can go, even though the market is, a sideways market is frustrating, I think it kind of gives us time and pause to analyze the fundamentals. And this is what's happening. We're looking at high tech, struggling with revenues, struggling with employees, looking at laying off, big names struggling. We got, things happening still in China affecting things like Apple and a few others, and, some materials going into high tech components that we get from overseas. Lots going on. And what it does gives us a little bit of time to digest all that information. Yeah, we got, we had a sell on that. We didn't get the best. We went short on the NASDAQ. So that's a good thing, right? And hasn't really, since we're going sideways, hasn't taken off as we would normally see in a very rapid moving market. That's okay. We're still doing well there, and we'll probably add to that if the market kind of settles after this week. But we know it's a weaker industry. So there you go. We also look at small caps. Small caps is really doing much better than we expected. But again, that's below the 200 EMA. Technically, they're now below the 9, and they're coming around the 14 EMA. It's still a buy signal, but it's struggling to make an advance. It got about halfway up towards the bear market summer rally, so we're struggling a little bit there, but it's still holding, and we're holding, that. So we're holding long in the SPY and the large cap as well as the small caps, and we're short on the NASDAQ. So we're kind of feeling our way through the market. I want to go over some energy plays. I'll look at XLE. XLE is our ETF for the energy fund. And we talked about this last time. See this cone on the Twomey trend track line, and now it's expanding a little bit, which is, think of it this way. If this line comes down because prices drop, and it's pretty intuitive, right? We're not, this isn't rocket science knowledge, but it's always this is always helpful from it, when you're charting, right? Daily chart. This is a daily chart. As it comes down, in order for that line to come down, the price has to come down and push that line down. Right now, this cone is developing, right? Normally a Twomey trend track line, we'll see it's fairly like a railroad track, right? They're parallel. Well, we can't draw parallel here. We try to go to 3 or 4 bottoms, to make our line intersect. And sure enough, what's happening is this tightens up. That means prices are flattening out. RSI here was high of, oh my gosh, there was 71.9, almost 72, and now it's down to 62. So I think we're doing pretty good, and that leveling out. We've changed our stops. Will energy pull back a little bit here? I think it's had a tremendous run. I don't know where it's going to go, but fundamentally, companies are still doing well. They're still supplying, and I believe there's still a shortage with the Northeast is short on diesel. We're short overseas on some of the fossil fuels, natural gas. They've got a nice stockpile for the next 6 to 8 weeks. If temperatures retreat, we're gonna find all that stockpile go up pretty fast, and they got to get it from somewhere because Nord Stream's closed, right? So there's potential, but we're we've changed our stops because we want to protect our profits, and we are near the top of the Twomey trend line here on Exxon Mobil, and we do expect some pressure, and that may be a midterm pressure as well. Let's see, UNG, U.S. natural gas. This has been all over the place, and now they're saying, oh, it's not. We're going to have a warmer winter. This is the U.S. natural gas. Let's face it, the natural gas went up because we were spending or sending a lot overseas to Europe. Europe's now full, right? So now what's happening? We've got this expanding cone versus a straight line, and that's telling us that price pressure. And simply added, it's in our market report, what has happened there fundamentally. We've sent a lot of natural gas overseas. It's a big, it gets complicated because the way East Coast and the South supply really the world. And with that said, we ended up spending quite a bit overseas, and that helped overseas during the Ukraine war. Now that they're stable, they've got tankers sitting outside, there's no place to put it. Pricing is coming down. We're short here in the Northeast, but it takes a number of days to get it up here. It's a very complex formula, if you will, and people are afraid to if they send it and price is changed on the downside, they're going to lose money. Again, it's all based on futures, where it's going to, prediction of where it's going to be several months out. That's the way energy works. It's very volatile. We always say that if we are playing energy, we got to be very, very careful. Let's see what else we want to look at. UUP, that's what I use for the dollar. That has flattened out, right? And look at this. We came out of the Twomey trend track line that had been a parabolic for quite some time from 2022, and now we're finally flattening out. We came down at a 0.23 retracement on a Fibonacci on a technical basis. We're testing it again. If the dollar stabilizes, that's going to help. The dollar is stabilizing for a number of reasons. Maybe interest rates are going, if we go from 0.75 to 0.5, it looks like in December, it looks like the end is near on interest rate increases. So that's affecting a lot of things, and including the dollar. So if the dollar comes down, we expect commodities to go up. And now let's look at our gold miners, GDX. Going over a lot of things here just to give you an idea. Now look at this, the Twomey trend track line. We broke above it. We do have a buy signal. I'm waiting on this to alert subscribers if we are going to buy. It looks good, it looks healthy, but I really want to wait for CPI. With that said, we got plenty of time. If it races off, gold has been struggling over the years to really come back in fashion. So I'm not too worried about missing out on that. The other aspect that we talked about was TBT we're still short the bonds. This is the 200 times play. We did send a subscriber update on that. Hopefully you all got that this week on how to play this going forward. And I think this coming down, it keeps trying to hit this lower Twomey trend track line. It's now at the 9 EMA. It's getting, the RSI is down quite a bit, 58. This one was way up. We were up in almost 80, and it was 80.7, 81. We're down now at 58. That's been the kind of range it's been at when it gets at this Twomey trend track line on the lower blue here. I know we got stopped out on our first third and second third. We've made some changes to that position this week. We are looking at potential sideways action on this, and we're going to we know yields are going up. There's no doubt about that, but it's going to be less of a rate increase in December. They're predicting 0.5. The pivot is off the table. I don't think that's going to happen. and we're going to have to really raise rates a little bit more to get up to that 5.5% what the Fed wants, and then we're going to come out of the woods. So I think the first we could be in a sideways move the rest of the year, or we could potentially see some changes the first part of next year, and that's where we're going to go with this. Let's see if we covered everything. Okay, stocks review, what's next, insight on market fundamentals. So that's what we are. This is the Twomey Stock Market Report. I'm James Twomey. And of course, if anybody is, we could go to the website. That's the number 2, mestocks.com. You should be getting your alerts. If you're not, log in. There's the weekly newsletters there, the trade trackers there. Videos will be posted there. Any questions, email me at info@twomestocks.com. That's the number 2, mestocks.com. I'll get right back to you with whatever you require. If there's some subjects you want to talk about, let's go over it. We'll do that. If there's advanced decline, I'm going to wait and go over that next week, or the end of this week at the next segment. So let's skip that for now. I think that's really important. We're seeing some great developments, but I got to wait to the CPI to go through that. So that's this week's weekly report. Update on our stops went out today. Please take action on those. And I'm James Twomey. Today is Wednesday, November 9th. Have a great day and happy trading.